Live. Good morning to all, and we are live. And happy morning to go. Happy Friday. It is the end of the month, the final day. There was an old song, Vernon, that I used to remember, the final countdown. I can't remember what that group was called, but I just remember that TKZ remixed it for their song, for their famous song Shibo. I don't know if I'm busy, if I'm referencing something that's a bit too old for you. How are you doing, Vernon? And how is your Friday going?
The day's good so far, thank you. How are you today yourself?
We are good, we are bright, we are early, and we are ready to rock and roll. And a good morning to everybody. Let's get going as we start off into Futuristic Friday. Today, we're going to be talking about quite a few things. It is a data heavy day. So all have to be prepared for that. It is a data heavy day. In other words, we're going to be going through quite a lot of numbers today. It'll be a day where we'll be touching on in inflation data. We'll be touching on trade data. We'll be touching on GDP data, and also starting to get into some interest rate data that we've captured from the recent auction. Obviously, we'll go deeper into those auctions coming up next week. Obviously, we are in post loan. We're in the post loan session, and the big topic of discussion today will be still part of another part of the series that has to do with the Bloomberg Africa Gateway, the Bloomberg. What's it? New Economy Africa Gateway Summit, where they were talking this panel specifically about development of the African value chain of the green energy industry. So let's get down, Vernon, to a bit of the markets today before we get into our major topics. And today being Futuristic Friday, let's touch into the data first. Data first that we're starting to look at first and foremost that we look at is that the Kwacha continued its negative slide, closing at 17.408. So we're not yet at that point where we're seeing the Kwacha moving into major positive territory. Although I still do only see it settling somewhere between 16 and mid 17. That range is probably what we're going to be seeing for the next how long? I think that's going to be the next 5 years of our country. Because remember, I showed you before that whenever we have debt restructuring, there is forex stability. And there's also some backing to that now because most of the forex outflows are not going to be as pronounced as we thought. Forex outflows in this nation are not going to be as strong, mainly because we're not going to be paying as much attention to the forex outflows going forward. Mainly, as I said, because our government will not be paying as much in forex outflows going forward. Next thing that we also take a look at now is the stock market closed yesterday 0.31% up as Zanaco and Standard Chartered both registered higher share prices on yesterday, with 0.13% also up on the week, 0.17% up on the last 30 days, and the stock market is up 12.41% year to date. So this is a good end to the half year. We're expecting it to be. ZCCM results did come out, and we're going to keep looking into them as well. The bond market also came in 0.6% stronger, and in the US dollars it was down 1.09%. But interest rates are actually up, ironically. So data is actually showing that interest rates are actually coming down. This is the second consecutive day we've had of rallying interest rates, getting back to about 24.0834%. So which is showing that we are starting to get that pressure pushing down interest rates a little bit, as we still get those little sporadic spikes in the market. As we've said, year to date, the dollar is down 3.41% on the month, down 10.86%, but up 2.4% on the week, and up 0.7%. The rand is the one that's also most important for cross-border trading activity, up 0.92. It closed at 0.9296. Up 0.11% yesterday and up 1.56% on the week, but down 12.96% year to date, with more negative days on the rand coming down the barrel. So a weaker rand is still good for cross-border trade, and therefore keeping things coming in a little bit cheaper for our friends who like to hop on the bus, grab things, and bring them back to Zambia. What we've seen also is that the bond market, we have seen that bond market year to date is up 13.27%, with 0.06% up yesterday, but down 1.09% on the USD measure of the bond index, but up 17.15% year to date. So if you're an offshore investor or a Zambian who's living abroad in dollars, you've actually now made a gain on your Zambian bonds. Interest rates came down 0.012% yesterday, but still up 0.44% year to date. Commodities yesterday, we did see copper come down on weak data that was expected from China. That was the main thing that drove commodities, but it did slide up just a little bit on expectations that weak economic data from China is going to yield some stimulus. So this morning we did see copper start to open a little bit stronger, while oil was up a little bit yesterday, 0.47% upwards on the market. Also, same understanding, but gold is down 0.23%. Year to date, we have seen that gold is up 4.93%, and copper and oil are both down. So this is showing signs that we're on the weak side of the economy. After all these rate hikes you've been seeing in developed economies, we're starting to see some really tough comebacks here. Wealth insurance assets, we did see Bitcoin up 0.9%. It is trading at the higher side that it's been up 77.07% year to date. But remember, on the quarter, Bitcoin has had a very, very bad quarter so far. Ethereum up 0.1% from yesterday and up 49.12% year to date, with gold up 0.51%, mainly because of the loss in the value of the kwacha, and not in the fact that gold is rallying itself. It's off those highs of 38,000 and still at 33,000. So it's off, it's down 13.28%. And this is why I keep saying these assets are very volatile. In the interim, they're actually quite volatile. But this is where we stand at the end, almost at the end of the quarter, 29 June 2023. Bonds are up 13.3% on the secondary market. Stocks are up 12.4%, with USD down 3.4%. Gold only up 1.3%. The cryptocurrency mainly up due to that first half of the year, that first quarter of the year rally where Bitcoin really pushed a strong percentage. And then we also had the weakness of the currency that also doubled up on that. Now, in terms of our four horsemen, we actually are looking here. Spanish inflation was up declined to 1.9%, while South African PPIs declined to 7.3%. However, German inflation did start to rise, showing that there is a little bit of stickiness in European inflation. UK consumer credit dropped to 1.14 billion, while lending to individuals rose. UK consumer credit rose to 1.14 billion, while lending to individuals rose to 1.1 billion, while US continuing jobless claims rose again. That's good for interest rates because a weak labor market in America is likely to make the Federal Reserve continue to pause. US short-term interest rates also auctioned higher yesterday, while Japanese household confidence rose to 36.2. EU business surveys did show that their consumer and business confidence has come down, as again retail sales in Korea have come down, while China's non-manufacturing PMI is positive but dropped to 53.2. UK mortgage applications rose to 50,000. Rose to 50,000. Unfortunately, American US pending home sales are down 2.7%. PMIs, and this is the biggest story of them all, Chinese PMIs are still negative for a second consecutive month, with Korean production also down 7.7%, as well as Japanese production. So what are we getting on the long end of our four horsemen? Inflation still coming downwards with a little bit of stickiness that's showing in Germany. Interest rates also looking like they've hit their peak, but unfortunately international growth is still slow as confidence levels are weak, while industrial data is also starting to show those same cracks. So the growth side of the spectrum is weak, but the monetary side is looking like it's starting to cool off, and it's going to lead, I think, into maybe a recovery, into a recession, which will then build into a recovery on the growth side. On the other side of this, Vernon, we'll get into GDP data and the other data that came out yesterday: inflation, GDP, and trade data, as we prepare ourselves for our final topic of discussion. Get you on the other side.
and of course, continuing the conversation where we were actually left off.
Thank you very much, and thank you all for rejoining us today. So let's get into some of the data that we picked up on yesterday. First thing that came out yesterday was inflation data, the June 2023 inflation report. Now we did see that inflation did come down to 9.8%, as from 9.9%, and that was mainly driven by what we call base effects. And I know people have heard base effects used whenever inflation goes up, and they always say, how come it always goes up on base effects and never comes down? Well, the truth of the matter is this one actually mainly came down from base effects. And mainly because monthly inflation did come up, but annual inflation came down. That's usually a sign of base effects. Kicking in, and that's mainly because I think it was that's mainly because we did foresee that some of the drivers in inflation from the transport sector did come in. But one of the things that does actually affect inflation reads that June 2023 month-on-month inflation came in 0.8%, and this is higher than 0.6% in the last month, and also higher than the expectations for June. So this means that it's coming in hotter than expected. And the main driver of this is the reflation in transport prices and the rise in breakfast meal prices. While global prices still remain elevated, they are still declining. So I think that's a very important factor for all of us to actually keep in mind. Now, we've seen that from this last inflation read, we did see that non-food inflation did pick up, while food inflation slowed down, and it mainly experienced the bulk of the base effects that we're talking about. This is what moved inflation from 9.98%, that's the middle line there, down to 9.97%. So the top line there is your food inflation, bottom line there is your non-food inflation, the middle line is your general inflation. It's like a sandwich happening right there. Now, here's what we have in terms of our inflation reads that we look at. The red one is the monthly benchmark, and the black one is the actual inflation. As you can see, for June 2023, which is most important, we were only expecting 0.45%. Our expectations benchmark is based on 10 years of inflation data. That's what you have to bear in mind. Our expectations benchmark is based on 10 years of inflation data. So we actually have seen that the 10-year average for June months of monthly inflation is only 0.45%, while we have seen it came in at 0.8%, meaning it came in hotter than expected. So we track monthly inflation so that we can get a leading indicator of whether inflation is actually picking up, because the annual inflation is a little bit of a lagging indicator. Okay, so we kind of use that one so that we can project where things are going, and we're seeing that inflation is hotter. Which side did it come from? Food inflation came in hotter than expected. It was only meant to be 0.29% according to the 10-year average for June. We came in with 0.88%, which is almost 3 times higher than what was expected, meaning this was where the core problem was coming from. And also, food inflation has been coming in hotter this whole year. I think only in March have we seen food inflation come in below the expectation, but for the last couple of months, it's been coming in slightly above the expectations, not too much. This one came in a lot above the monthly expectations curve, meaning that food inflation is coming in a little bit hot. Obviously, that breakfast meal prices did increase back to record highs of 206 kwacha. Now, we did see that the monthly kitchen table index, we did see a lot of things stayed flat. Grain prices only went up by 0.1%. Chicken and egg prices up 0.85%. But it was fruits and condiments that went up by 3.4%. But it was really the breakfast meal prices that were the main ones. Here we are, breakfast meal price inflation up 25%. Sorry, I think our logo's blocking that one. But it went up to about 25.6%, not the highest of 25.7%. And these are grain prices. This is grain price inflation as well. I'm not showing that it moved up too much. Now, if we're looking at the non-food inflation expectations curve, we can see that that one came in line with expectations. Non-food inflation was supposed to come in at 0.98. This is when we usually see higher levels of non-food inflation. It only came in at 0.69%. So there wasn't that much heavy month-on-month inflation on non-food inflation. So we actually did see that managed to control and contain itself. Now, when we take a look at the inflation by category, what we see now, the main drive, the biggest performer was communication and recreation. recreation and culture. That came in at 2.2%. Obviously, recreational activities, with restaurants and hotels coming in at 1.8%. There is still a lot happening in the recreation industry, and that's why we're seeing quite a strong level of inflation coming in. Also came in quite strong as furnishing and equipment, and transport reflated back up in terms of the cost of transportation services. So I think they were just lagging, and they were just sitting on euphoria from the last time. Now, in terms of year-on-year inflation, the most inflationary sectors have been food inflation is up 11.2%, and transport inflation up 11% year on year. The next one, obviously, is restaurants and hotels and recreations and culture. These are the heating up sections of the economy. Actually, if you take a look very carefully, those are also some of the best performing GDP sectors of the economy as well. Other parts that we've seen right now in terms of the key triggers for monthly net inflation was that transport inflation did push inflation rates back up in terms of monthly, while housing inflation and utilities pushed it down monthly as well. Housing inflation was one of the key. Food inflation was a bit of a trigger, but not too much. Main thing that we saw pull inflation down was the base effects that we found in food. So you can see the biggest drag on inflation was the base effects in food on months net annual inflation. So it shows that the key trigger was that. So part of what I've said here is that inflation still seems to be stuck between the 9 to 10% range. The 9 to 10% range was one of the biggest was one of the biggest drivers of inflation. Sorry, it's one of the biggest areas that we're seeing inflation holding. So therefore, I'm still seeing that we still have some risks on the horizon. It's a good thing we've managed to get our debt sorted out, but in the short term, we're still seeing that the 2, 3, and the 5 year bonds are still the nimble areas to kind of navigate this thing. I have talked about people learning to position themselves. So take your time in that transition. The markets are still prepping themselves. There's still a recession to go through. We still have to finish with private creditors. There's still a bit that has to be done before we start to see the stock markets fully take off. So I'm just telling you to really pile in and hold your bonds really strong so that your high interest rates are still sitting there. We're still sitting with relatively high interest rates. The reason I say this is 2, 3, 5 year bonds are going to give you that nice base of high fixed income that comes in, so that when you start transitioning into the riskier parts of the market, you have these stable flows of coupon payments and interest that you're earning that you understand, and that is way above the projected inflation going forward. If you're an equities investor, this is the time to start looking for stocks that are not highly leveraged, and stocks that have got market pricing power to navigate this low area of inflation, because our inflation is not rising, but it's sticky. It's stuck around 9, 10%. And as we can see by where we have been, it has been there for some time. In fact, if I can just go back to the chart on the original inflation read, you can see that we've been in this 9 to 10% range for the last part of 12 months, for the greatest part of 12 months. Now, coming out of inflation, and let's get into trade data, we also picked up quite a bit on the May trade report yesterday. We did see that May trade data improved 108% from 25 million kwacha dollar deficit to a meager 2.2 million surplus. Now, this is one of the smallest surpluses we've seen out of all the surplus months. May's trade surplus of 2.2% was down 99% year on year, and the year-to-date surplus of $311 million is down 79% year on year from where we were in the previous year. Now, the key drivers were a slight reversal. This slight reversal was an improvement in exports, and specifically copper exports, which are still below 600 million, but the highest they've been in 4 months. We may also see that slight recovery also saw a 4-month high output of 68,000 metric tons of copper as well. Although one of the biggest pieces of news we should see was that even though import growth slowed to 13%, there was a 14% year-on-year jump in consumer goods import. For the first time in Zambian history on record, now I've gone back as far as 2008, we saw consumer goods imports top $300 million. Zambians imported $300 million of consumer goods in May 2023. This is the record, which means it seems as though the Zambian consumer seems to have recovered. Either the cost of things are also very high, but the Zambian consumer seems to have recovered. Unfortunately, at the time, the producer and the rest have come down. Now, here's what we've seen in terms of the comeback. We saw that there were 2 consecutive months of deficit, and it looks like we've come out of that. And hopefully, we're going to build some momentum going forward in terms of trade. We're still seeing very weak trade, by the way, 99% down year-to-date trade, and monthly trade down 79%. So 79% year-to-date trade, 99% down. Year-to-date trade 79%, monthly trade down 99%. Now, one of the things that did help yesterday was we did see that imports slowed to 13%, from 20%, because they've come down from 35% growth to 20% to 13%. And now what we also have seen is exports of the export contraction has also started to slow down from 21 loss to 13 loss to 9 loss. So this is where we're actually seeing a little bit of a recovery in the export sector. Now, agricultural export did jump up 25.3%, but unfortunately, it's still down 4.4% from where it was last month. $58 million worth of agricultural exports, what we're actually looking for. It was the non-traditional, non-agricultural exports that were the star export performer, up 43% year on year and 18% month on month. This is our tobacco export, our cotton export, whether it's our biscuits or our milk, our biscuit kind of exports. Also, our exports in alternative metals. Those are the other ones that we also pay attention to. Now, what we did see last month was a 9% recovery in copper export revenue, up to $592 million, because it was starting to get down to about $550 million. So that extra came back in and revised it up. Now, year-on-year exports for the month are down 8% from where we were, but they're up 12% from the previous month. So that recovery is what has helped us. Now, month on month imports grew by 9%, but you can see the big one was the 39-40% jump in consumer goods of $306 million worth of consumer goods imports. Capital imports are only up, rose only 4% on the month, but up 84.2%. Mainly, this is mining companies importing. This is mining companies doing imports, while intermediary goods are down 17.1% from last year. They're having a weak time. And also raw materials are also finally starting to come down. Remember that the cost of commodities around the world is starting to come down in dollars. So I think it's reflecting also in the raw materials imports numbers. So we can see that it was slower growth in imports and faster growth in exports for the month that actually led to a pickup. A 12% growth in exports and a 9% growth in imports led to a $2 million surplus. So basically, we had a trade neutral month in May. But we have seen that in terms of year to date, our agricultural exports are up 11% from last year. Still, we're trying to see if we're on track for the $1 billion mark, seeing if we can finally beat $1 billion of agricultural exports. It looks like it's a slow month to do this. We were expecting to crack that because we managed to get past $900 million last year. Now, to continue that kind of rally is where I think we're having a bit of a problem, because we have depended on trying to export our agricultural products, but that has also brought inflation problems with it. So policy is fighting us from whether we can export agriculture. But non-traditional, non-agricultural products are up 25.3%. Versus month on month, and up 53% year on year. Still, mining export is down 21% from where we were last year. Now, from what we're seeing in terms of total exports year to date are down 5.6% from where they were last year. Now, if we're looking at imports, they're up 25.8% from where they were last year. And the biggest one is still consumer goods imports. Zambians have imported $1.3 billion worth of consumer goods in the first 5 months of the year, up 49% from where they were. Capital goods are up 61%, while intermediary goods are down 3.2%. And raw materials, $414 million worth of raw materials imports, up 43.2% from last year. But mainly that was the beginning of the year and the elevated oil prices and the input prices. Now, part of what we also pointed out was copper outputs, 68,200 metric tons, up 18.4% from last month. This is one of the bigger recoveries, but down 11% from where these numbers were in the previous year and down off the highs of 2021. In terms of year to date, these numbers are still 15% way below. So we are struggling if we're still going to even think about hitting that 2 million output mark by 2026. That's a big one. We're going to have to see some furious growth in the mining sector 2024, 2025, and 2026 for us to be able to justify seeing what we're seeing. I only see the mining sector ramping up production probably on the other side of 2025, not 2024. There'll still be too much of a global copper surplus for them to be incentivized to do that. Now, as I said, in terms of copper outputs, this is the highest that we've seen copper output since January 2023, where we saw it at 72.6. It's still higher than where it was in December, but not as high as the months we were seeing, where we were popping out 80 to 75,000 metric tons of copper output. Now, copper output is still down 16% from where it is in terms of year-to-date. Copper output is down 16%, but monthly copper output is down 12% from where we were last year. And copper revenue, $592 million, finally bounced back up the 550 million mark, and we are heading to, but it's still way below the $700 million mark that we were hoping for. And for a country to try and make billions in terms of off its copper industry, remember our mineral royalties are coming in low because of this level of this level of low performance. Now it has jumped to a 4-month high, but this is the fourth consecutive month of under $600 million. We're looking for about $750 to $800 million at least worth of copper revenue for us to get some good mineral royalties. And this is what we've seen in terms of our non-traditional. Now, agriculture still coming off those lows of $45 million that we saw last month, back up to 57, but it's still much lower than the $80 to $90 million we were getting accustomed to from agricultural exports. So we're seeing weakness in agricultural exports, weakness still in mining exports, and that's going to reflect in a lot of the GDP data that we are going to point out very soon. Other data that we picked up on my recommendations coming out of this is that we are still in a slow growth environment. Now we have a good outlook, but still in a slow growth environment, along with GDP coming in at an eight quarterly low. This signals that GDP is still slow, and we're still seeing stagflation assets. 1 to 5 year securities are still the best thing. Inflation-proof dividend-paying value stocks with pricing power. And if you want to go defensive, your crypto assets, but don't take it more than 10 to 15. Your gold, dollars, and crypto assets, don't take them more than 10 to 15% of your portfolio. So that is where we see trade settling in. And finally, in terms of yesterday's news, let's get into GDP data. And this, I think, is one of the most interesting parts of it. Now, Q1 GDP data of 2.3% was the lowest that we've seen in 8 quarters. Key drivers of GDP growth were education, finance, professional services, manufacturing, and ICT. Draggers of GDP were agriculture, mining. The draggers were agriculture, mining, wholesale, retail, electricity and gas, and public administration. Now, I've got a little bit of a problem here because a lot of our policy support is actually sitting in the dragging areas. The areas that we're supposed to be seeing good policy support is actually in where we're seeing the drags, because we're putting a lot of public expenditure and public support into agriculture, into mining, into trade, into gas, into electricity and gas and public administration. But this is where we're seeing the poorest economic performance. So we want to know whether are we targeting strategic growth areas, because education, finance, professional service, manufacturing, and ICT seem to be the areas where we're having strong growth. And should we not be lighting a fire beneath those areas as opposed to putting so much energy behind agriculture? Mining, I understand why, but that's a deeper conversation. But as you can see, this is the lowest GDP growth in 8 quarters. 2.3% is only lower than the March 2021, when we're just coming out of the pandemic. So a lot of the momentum that we were getting from September 2021 seems to be lost. And it has been waning since Q4 2022, because we really had a strong 2020. We really were on track for a very strong 2022 until the final quarter, when we started to see some very, very poor mining output. So the bad mining sector that we've been having, and agriculture. So the poor performance in agriculture and mining have really, really dragged the economy down in Q4 and Q1 2020, Q4 2022 and Q1 2021. So this has been the key drag point. Now let's take a look at who have been the key performers in terms of quarter one GDP data. We've measured quarter one GDP data. The second bar is quarter four 2022, and also quarter one 2022. Sorry, quarter one 2023. Second bar is quarter four 2022, and the third bar is quarter one 2022. Now, if you see, professional services were the top performer, 30%. They were the highest GDP that was gained, 30.5%, but they're also lower than where they were first quarter last year. If you're looking at hospitality, that has come in stronger. It's much higher because this is the reflation of hospitality, reopening of all sorts. The pandemic it's no longer labeled a pandemic anymore, though we're starting to see cases resurging, but 28.6% in terms of that. Education up 27.4%, slightly down from where it was in the first quarter of last year. Human and health services, 18.9%. They've been running quite strong as well, with financial services up 18.1%. So the strong accelerating areas seem to be hospitality, human and health services, and financial services, while education is elevated, but the growth, the acceleration of growth is not that strong, but 27.4% in the education sector, really strong. Now, the worst performing GDP sectors, and I said this again, it's the key sectors of our industrial plans as a nation. Agriculture and forestry down 17.3%, very bad on the economy, way worse than where it was last year in the same quarter, 46.2% growth. It was one of the fastest growing sectors in the first half of the year, and it has gone to one of the worst performing sectors in this part of the year. In the first half of 2022, now it's one of the worst performing in the second half of 2022 and the first half, and it seems to be the first half of 2023. Mining it seems to be in a recession at the moment, down 12.6%, with electricity down 3.4%, wholesale down 1.3%, public administration down 0.3%. Now, if we're looking at the key drivers, now these are the things that actually created the 2.3% economic growth. The first and foremost biggest contributor to economic growth was education, up 2.4%. 27.4%. Financial services was the next biggest contributor with its 18.1% GDP growth. Professional services was the third biggest contributor. Manufacturing was the fourth biggest contributor, and ICT was the next one. So these were the main drivers of economic growth. While the biggest draggers of economic growth were agriculture, which was one of the biggest drags. It basically neutralized all the gains from education. Mining and quarrying was the next one, which basically neutralized all the gains from the finance sector. While wholesale and retail was they were pretty. That was the next biggest drag. Electricity came straight after that, and public administration after that. So we really have seen five key industries which have been targeted to be the ones that are dragging the economic development of our country. So let's quickly get into some deep dives. I don't know if we have Vernon back to start our conversation to see what are your thoughts, Vernon, on the GDP data. I'm not sure if we have him back, but let's move into our deep dive for the day. Now, our first deep dive story for the day is Fitch Zambia. The Fitch rating agency has saying it's awaiting Zambia's agreement with private bondholders before upgrading its long-term foreign currency issuer default rating from restricted default back upwards. So before we can get re-rated, this is the thing that brings capital back into your economy and floods your market with capital, is where you have a stronger sovereign rating. So the sovereign rating is now contingent on whether we can get our private bondholders to meet an agreement. Now, the Zambian Ministry of Finance has confirmed that about $1.7 billion in commercial creditor claims insured by China's Sinosure have been reclassified already. Now, Zambia's long-term local currency issuer debt default rating is still at triple C, though we still like that higher, as of December 2022. So these ratings are waiting for us to finish our private bondholders conversation. So if you're still waiting for there is still a hurdle. That's when you get reprofiled. That's when you can get more capital coming into your country. Until then, Fitch has held their rating, even on the news. Other news that came in yesterday, and this is going to line up with a lot. Tanzania's Taifa Gas and Zambia's Delta Marimba have joined forces to build a $100 million, 100 megawatt LPG energy facility in northern Zambia. This thing has already gotten its approvals. Now, Zambia eyes increased power generation to increase consumer demand and also to get to the mining sector, positioning itself to be an electricity hub. Tafia Gas also wants to explore cooking gas. Remember, that's a big business that even Puma Energy has gone into with its purchase of OGAS for $3 million. Other news that also came out yesterday was the Minister of Energy says the government cannot procure petroleum products because of a $700 million debt that's still hanging towards international OMCs for fuel imports. Now, the debt results as the quarterly, monthly, or the quarterly price reviews that were done. Remember that we said that there were a lot of underpricing. Because it was election period. The same thing you were finding in Nigeria. There was a lot of underpricing and a lot of fuel subsidies that have led to a $700 million debt that still has not been cleared. These are still things, by the way. As we're still negotiating $6.3 billion, you got $700 million worth of arrears that you owe international oil companies. Procurement of fuel is still currently being led by the private sector. But the minister did mention that petrol shortages will start to normalize in the next few years, in the next few days, as 5 million liters of petrol has injected into the economy. So that was some of the main news from there. Now, let's get, I think we finally have Vernon back. So we do see, Vernon, that I was trying to capture some of your thoughts, Brother Vernon, on our GDP sectors, and what are your thoughts specifically on the fact that the key sectors that we're looking at, be it agriculture and mining, seem to be horribly underperforming, while the sectors we're not paying as much attention to, such as the education sector, though we are giving some fire to it, but such as the education sector, ICT, and manufacturing, they're the ones that are actually holding up the economy and have been holding up the economy for some time, including transport as well. Should we be maybe basing our development plan as a nation on the fast growing sectors? Because I'm thinking, if I was a business and I've got 20 SKUs of income, if I'm looking at my top growers, I'll invest heavily in my top growers and then just maybe put some down policies. But I understand possibly where policy can come from. But what are your thoughts?
I think every sector on the table should ultimately be considered and given, at least ample attention so that they can also be allowed to grow. Growth, of course, it may not really be the fastest to yield as much returns or maybe towards the GDP of a country, but every sector should be accorded at least some sort of attention and allocation of maybe funds, time and forth, to see how that can equally contribute significantly. And maybe because it always has been tradition to focus more on mining, agriculture, and whatnot, and this is why maybe we are seemingly every now and then you talk about the economy growth and how we can pull, more resources to see how we can stabilize maybe the economy. We're always pointing out to mining, agriculture, and the usual. So I think moving forward, we should be able to also have an outlook of just what the future is like you mentioned, some of the fastest growing economies, and what could possibly be more lucrative for the government itself and just primarily the people. The education sector, of course, being one of those which actually has been around for the longest time, and a lot like you put it, yeah, in that regard. And I think in every aspect, it has the potential to significantly contribute towards, economic activity, employment as well, and essentially stabilizing of an economy. So I think we should equally consider and also have a thought for the future as into which ones will be most the most burgeoning at the time, and we could possibly leverage from that moving forward, and try to squeeze out every nutritional opportunity that could also be able to offer employment to as many people at the day.
True, and but I would say this, Vernon. One of the things we should consider is that whenever I'm looking at job creation, yeah, in a country, the fastest growing sectors of any economy, in terms of job creation, the best paying jobs are found in STEM jobs and finance. Okay, STEM and finance, and STEM being science, technology, engineering, and mathematics. This is where you find these are the degrees that often pump out the highest paid people, even here in Zambia. If you're going to be somebody, being an engineer actually gets you paid quite well, especially if you're an engineer in the mining and the energy space. Those are very two lucrative positions that you often find. Engineers are often very well taken care of in those spaces, mining and energy. However, uh, they so we've always categorized STEM for its ability to pay well, but I also would take into consideration what we call HEAL. Because HEAL also deals with where people can receive decent pay as well. And HEAL is your health, education, administration, and literacy. That's where you get the highest number of fastest growing jobs. So it depends on who you are. If you're a phenomenal student, STEM. If you're a poor student, HEAL. But you want to make sure that that's where you go to. So just keep those two acronyms in your mind. So I do understand why we invest heavily in why we should always consider the HEAL side of things, and HEAL being especially your health, education, your health and education. Those are areas where we do get quite a bit. And those are some of the faster growing areas that we saw contributing to economic growth this quarter. It was health and education. These were very fast areas. Also, tourism is one area that we are paying quite a bit of attention to. But I understand why we have to invest in mining. It's because most of our debt is leveraged against mining. Okay, it's leveraged against our mining because our capabilities to pay back our dollar debt is based on our ability to raise mineral and mining taxes off the major mining corporations and to have mining profits centered back in Zambia. That's the deeper part of the conversation we need to be paying attention to. And the reason I say this, Vernon, more than anything, is simply because if we can keep our eye on, if we can keep ourselves earning that, and it's because our topic of discussion is about to be on that, how to maximize the mineral value chain for the green transition. Now, this was a conversation that was being had by the Bloomberg Gateway forum, where it was the minister of mines in from Ghana, with also a lady named Josephine Wapakabulo, yes, who used to be the CEO of the Ugandan oil company. And she's pretty well known. They were talking about how Africa can leverage its growth and how Africa can leverage the green value chain and what policies we need to start looking at to maximize. And I think for us as a country, remember that the next 10 to 20 years are based on how well we can leverage and ride the green transition. I think if there's any Bloomberg New Economy Gateway Africa conversation that all of our policymakers should be listening to, I urge them to go and look for one called Mind Your Business. Okay, Mind Your Business was a very important panel because it speaks to the policies that Zambia is going to need to implement in the mining sector. And you're going to see how important this are. But I'm going to give you a summary of what was spoken about there and two very key points about how they talked about the importance of utilization of hydrocarbons. But here's some data I just wanted to give us and just to lead up to all of this. So in our Figure It Out, we've got the number 30% of all known mineral reserves in the green transition, such as cobalt, manganese, nickel, graphite, platinum, and lithium, are in Africa. Okay, 30%. So mining has always been a conversation as to how our country can make sure that we're capturing the most value from this. Now, our chart of the day does show this is the future of the minerals that we're talking about and of the global electric vehicle battery demand, which is where most of these minerals are going. Take a look at the astronomical levels of growth just up to 2027, people. This is not 2070. This is 2027. So you're seeing that there has been a 10x growth in passenger vehicle battery demand in gigawatts. There's been a 10x growth over just the last 7 years. I mean, there's going to be a 10x growth in over a 7-year period. That shows you that this is where there is a strong level. Now, I'm going to be later on. I'm going to be giving the S&P has released a document called "The Future of Copper." which have just done, and it's going to be a very important document for all of us to get our hands on. The future of copper is a very extremely important policy document that'll guide our tax policies. It'll guide all sorts of policies that we need to be reading. So everybody look out for the S&P Future of Copper study that's been done. I'll try and see if I can put a summary towards it to try and help us see what we should be doing and how we should be positioning ourselves and what industries we should be leveraging on. Now, over the next 7 years up to 2027, this shows you where the balance of it is. And as you can see, in terms of nickel, cobalt, and lithium, and nickel being the best one to kind of look at, you can see that there's huge surpluses that are going to be built up to 2024. But you'll notice that from 2025 onwards, we're going into deficits, meaning the price of these minerals are actually going up. And copper is no different. If you take a look at even the copper chart, the global refined copper consumption per capita, if you take a look, especially going up above 2026, you can see that there's an exponential bump. This is metric tons of usage per 1,000 people. We are getting to that point where, in terms of as the global usage, we're going to get to a point where there'll be 6,000 tons of copper used per 1,000. So this next period, by the way, of this next 10 years, going up to the year 2035, 2036. That's where we're really going to see a huge spike in copper usage. Double the amount almost of copper usage is going to be needed just in the next decade. So it's very important for Zambia to ride the wave. This is why those debt repayments that we're looking at, they're saying we also need to consider what happens if Zambia's economic outlook improves. Okay, so they're looking at things like this. This is from the S&P Global Future Copper. This is one of the things that I will show you. So our main topic of discussion is about how Africa can benefit from the green value chain. Here's some of the key points that were being discussed. How can we maximize African benefit? Policies and interventions, oil and gas and industrialization, human capital, biodiversity, sustainability in mining and oil, and how to have a just transition of energy. For maximization of benefits, this is what they were talking about. We need to stop selling out raw materials. Now, Ghana is actually putting in place a policy that by 2030, nobody will be allowed to export raw versions of key minerals. So you can't just take rocks, put them in a truck, and get them out. You have to process them in country to the highest part of the value chain that you can if you want access to those minerals. So this is one of the policies that you're starting to see to try and tell people that if you want access to our minerals, you need to start processing them up to a certain point where we're not sending out raw materials and then you're giving us back finished products. So there must be policies to stem the export of raw or semi-processed materials, and it has to be a process, not an instance. Not where you just come in one day and say, boom, now we're stopping next week, effective immediate. The word effective immediate must stop from the vocabulary of our politicians. And we need to start now doing things gradually. Okay, otherwise, we're always going to be having these fights with our investor community. Now, part of maximizing is part of the Ghana example where they have said the value retention of bauxite, iron, lithium in Ghana. They are refusing the export of raw materials by 2030. So these are things that we should be considering about copper, nickel, all these things. Should we make sure that processing needs to be done to the highest point of the value chain? This is why we're also talking about EV batteries between Zambia and DRC. Hydrocarbons' role in green transition. This is what the lady also pointed out, that oil and gas is needed to produce energy for mining, infrastructure, and manufacturing. You may not like this point if you're a green wokey, but what you must understand is that the developed world who are busy walking around, what's her name, Greta Thunberg or whatever her name is, those people come from countries that have been using oil and gas for 100 years. They have developed their economies. They have 100 years of hydrocarbon-based development. So for them, they can grow a conscience. Africa has no such development. We are still majority rural. So we must be very careful of jumping on the bandwagon of all of these, for lack of better terminology, white countries who have decided that they've grown a conscience for the environment. Okay, yes, they are throwing around and splashing a lot of money, but Africans need to be very pragmatic about the fact that we still have to use hydrocarbons, because the fastest way to develop an economy and to industrialize is the use of thermal energy. Okay, thermal energy is what is the best at the moment for high speed development. So it is a battle to start using non-thermal energy and renewable energy. It's difficult because nobody has ever built themselves out of poverty with renewable energy. It is a tough swing, and we have to be very careful as African economies of trying to build ourselves out using renewable energy, when what we should try and do is balance it out, build on hydrocarbons, then transition to renewable energy. So Africa's transition will be longer. She did point this out. So we also have to remember that, because we still first have to go through carbon industrialization. And she did say that carbon industrialization is faster. Then you transition to green industrialization. And so there are ways that traditional fuels can be done better. Now, the policy framework that has been pointed out that we should start thinking about is that for the green value chain, we need a better railway system. The Ghanaian minister did actually say that underdeveloped railways are the biggest problems for EV minerals. And in fact, rail is more important than road. So we've been doing a lot of road infrastructure, but we need to also look at our rail, because rail is a more effective. And he also said also start investing in ports, and also having a automobile sector domestically can also help. But I think one of the best things I heard was Ghana is now working on tying its mineral royalties towards infrastructure investment, because infrastructure is what makes minerals come out stronger and a lot more, and gets more investment in your mineral industry. So one of the things that we should consider, Vernon, even going forward as a country, is should we not tie some of our mineral royalties? I know that we need to use a bit of our mineral royalties to pay back bondholders, because that's what they're going to be expecting, that mineral royalties should be used to pay back bondholders. And we have a tendency, Vernon, to utilize mineral royalties for purchasing of oil and also for social things. But should we not be funding infrastructure with mineral royalties? Because that investment actually improves the mineral royalties sector. Part of what they also said was that in order to attract investment, you need to make sure there's good rule of law, good governance, certainty, consistency, sanctity of contract, and protection from political change leading to change of contract. We shouldn't just wake up in the morning and, because a new party is in, all of a sudden all the contracts are out the window. And green human capital is also needed, Vernon, in that as a nation, we have very low numbers of engineers, very low numbers of engineers to actually start to utilize these services. And we need to start being deliberate. Africa scores very low in engineering skills. Our skills policy must force companies to have local employees up to certain levels in mining companies, energy companies, electricity, anything. We should need to make sure that it's not just menial labor that is brought in by investors. And we need to make sure that, and we do have that framework as well, we need deliberate policies of sending certain people to certain universities to make sure that a part of the bursaries that we're giving out at higher education should be for things like engineering, renewable energy engineering, mining engineering. These are main things that we need. And we need to get those people back, not where they go and study engineering and we never get them back. Because that's the biggest problem we have in Zambia. You send someone abroad and they never come back. We also need to look at the direct skills, also indirect skills. Who are the people who are good at green finance management? Who are the people who are good at green contracts, energy contracts? Those are law skills. So if you're studying law, skew yourself to some of these things as well. If you're studying finance, Corporate Finance Institute offers green ESG certificates, by the way. If you're studying that, study ESG certificate online. I think it's like $400 a year, and you can actually you can actually get certified in ESG finance. And that's very important to try and know where you're going in the future. And we also need people with good communication skills in these areas. So start to skew your work towards some of these areas. If you're young and you're trying to figure out, where am I going to have an impact in this green growth that's coming very soon? So perhaps start working to learn to skew your skills. Now, obviously, we've seen with our mining in South Luangwa the issues of sustainability and biodiversity. That's a battle that we're having here. But balancing biodiversity conservation and mineral wealth growth is a serious issue, because the poverty reduction of your country needs jobs from mining. And having a nice environment. You see, my problem I have with this conservation conversation, most of the time, it's void of the fact that Africans are majority unemployed and living in poverty, and we need to fend off these issues. And a lot of the time, you're finding very wealthy upper crust people from a lot of these, for lack of a better word, white countries again, who like to see Africa be their little zoo, well, like a zoo to them. That's where the problem comes down. And we have to be very careful. And I'm not saying we have to damage our environment, but I'm just saying it shouldn't be at the expense of poverty reduction. Okay, because they're in the lap of luxury after they've mutilated their environment, and now they want us to keep our environment so that they have a place they can go on vacation. So sometimes it shouldn't be in that regard. Now the growth versus conservation conversation becomes difficult, but I think one of the things that was pointed out is that we need to use data and analytics to help support where people can mine, where are the best places, so that we're not just scrounging out ground for nothing and destroying our environment. Other policies they did mention was things like artisanal mining, which is very difficult and it needs licensing reform, equipment for safe extraction, and enforcement. These are things you have to deal with, the artisanal mining policy. But one of the things she did mention was that the energy transition, because everyone is saying, what is the answer to having a just transition? One, it must be inclusive. It shouldn't just be a bunch of Western countries having coffee and tea somewhere else. And that was the nice thing about the new finance pact that was happening. Developed nations must honor their commitments. You cannot ask Africans to build out transition when you built your economies on hydrocarbon, and then this, because you had a meet with Jesus moment somewhere, now all of a sudden we have to pay the consequences and have a slower industrialization because you and your children are holding around waving placard saying "Nyama oil, Nyama oil." We don't want to hear those things. You contain your children, because unfortunately, they know very well that the fastest way to industrialize a nation is the use of hydrocarbons. And they know that for a fact because they know that they built it. So either they pony up the money for us to transition green, or I think there was an old statement, put up or keep quiet. And then finally, we must acknowledge that we're not starting from the same places. America, England, all these countries have had 100 years of hydrocarbon-sponsored industrialization, and Africa we are starting now. So you cannot ask us at our starting point to slow down. We still have 600 million people relying on charcoal for cooking food. And then you people all have stoves, and you want to start comparing our poverty. American poverty is I don't have gas in my car. African poverty is I need to walk 5 kilometers to fetch water. Okay, that's a difference. American poverty is I don't have enough money for electricity for my stove. African poverty is I have to go chop down a tree so I can cook. Okay, that's a difference. So we need to understand that we're not starting at the same place. But I'm going to leave this last thought, Vernon, from this same lady, so that we can just wind up for the week, where she talks about how hydrocarbons can play a role in the green transition.
The current green age that we're in, and this tension with traditional existing energy transitioning to new energy sources, the reality is, and I always say this and I qualify that I'm an optimist, but the reality is the time it will take to transition, particularly across sub-Saharan Africa, is going to be longer than other parts of the world. And so traditional energy sources, oil and gas, is still going to be needed, particularly gas, if we want to industrialize in the short to medium term. And that industrialization feeds into manufacturing, which allows us to start, as the minister rightly put, building our way through that journey. We're not going to leapfrog to the EV market, but...
Just to hold you there, so
yeah.
you're saying that countries should focus on gas rather than clean energy?
It doesn't have to be an either-or.
Indeed.
That's the point. And I feel we've made it an either-or. It can be, I think it's the CEO of ADNOC put it rightly, we don't have to say it's this or this or this. We can say it is solar and wind and oil and gas. And, you know,
I know a few people who would not be happy with that. But
they may not be happy, but let's talk about reality.
Okay.
Right? And until I see a technology advance that allows solar and wind to give the thermal heat power we need to run mines and to do industrialization, and we're all hoping for those technology sort of leaps. The reality is the traditional fuels we have today, particularly in markets that need to industrialize fast, we need traditional energy sources. And just to qualify that, you know, when I ran the National Oil Company, when you come later in the game, you can do it better. We put policy that we didn't do flaring. We made sure we followed all the IFC standards on nature and social impact. So there's ways to do it better that we can learn that still has less impact on the environment, as in parallel we do the green transition.
And that, Vernon, is where we leave it today. I know we really ran the clock on that one, but it is very important because these are the policies we should be talking about, because maximization of the green value chain is exactly how Zambia is going to grow its way out of this quagmire that we found ourselves in. With that, my brother, I'll leave you be and have a great weekend to you.